You know the name HP, right? Of course you do. You've probably used one of their printers, or maybe you're even watching this on one of their laptops. But here's the crazy part you might not know. If you want to invest in that brand, you can't just buy HP. You actually have to pick between two totally separate companies. So today we're going to untangle this puzzle and figure out which stock, HP Inc. or Hewlett Packard Enterprise, is the right one for you.
So let's just dive right in, because this is way more than just one company with two departments. Believe it or not, it's a tale of two completely different strategies, two different visions for the future, and two very different risk profiles. My goal here is simple. By the end of this, you'll know exactly which side of the HP family tree fits your investment stock. All right, here's our game plan. First, we'll cover what these two companies even are. Then we'll check the 5-year report card to see how they've actually performed. After that, we'll really dig into their strategies, check out their angle on the whole AI revolution, and of course, see what the price tag is. We'll wrap it all up with a final recommendation based on what kind of investor you are. Let's get...
Okay, first things first, let's talk about the split. Think of it like a breakup. Back in 2015, the original tech giant Hewlett Packard decided to go its separate ways, and it split right down the middle, creating two new companies. They kept the family name, but as you're about to see, they now live in completely different worlds.
Honestly, this one slide tells you almost everything you need to know. It's the whole story in a nutshell. On your left, you've got HP Inc., ticker HPQ. Just think of it as the cash cow. This is the part of the business we all recognize, the PCs, the printers, the consumer stuff. Its entire game plan is to be a stable, cash-generating machine. Then on the right, you've got HPE, the growth engine. This is the behind-the-scenes player. Servers, cloud tech, stuff for huge businesses. Its strategy is all about aggressive growth. So yeah, the verdict is simple. HPQ is playing defense, and HPE is playing offense.
So a cash cow versus a growth engine. Sounds good on paper. The talk is cheap, right? How have these two very different game plans actually worked out in the real world over the last 5 years? Let's pull up the report card and see who's been winning.
And wow, this chart really tells the story, doesn't it? See that green line? That's HPE. It's been kind of riding the big tech wave, tracking the overall sector's momentum pretty well. But then, look at that blue line for HPQ. Oof, it's been a much rougher ride, especially after that whole work-from-home PC boom just fizzled out. But here's the thing, that slump is exactly why some investors are getting interested now. They see a potential bargain, a turnaround story in the making. Okay, so let's pop the hood and really look at the financial engine of these two companies. This is where we get into the nitty-gritty, the stuff that explains the why behind those stock charts and shows us what really makes these companies tick.
You really don't have to be a Wall Street analyst to see what's going on here. Look at HPQ. It's like a giant, steady battleship. It's huge, but its revenue is pretty flat. It's a mature business. Then you look over at HPE. It's more like a speedboat. Smaller, for sure, but man, you can see that clear upward trend. It's all about hitting the accelerator on growth.
But, you know, making a ton of money is one thing. Actually keeping it is a whole other story. And this is where HPE has a massive leg up. Think about it. Selling PCs is a brutal, low-margin business where everyone's fighting over pennies, but selling high-end cloud services to big companies? That's where the real money is. And you can see it right here in the gross margins. HPE is just in a different league when it comes to profitability. So at this point, you're probably thinking, okay, HPE is growing faster, it's more profitable, it's the clear winner. But not so fast, because when it comes to the one thing that many investors care about most, cold, hard cash, HPQ is an absolute monster. I mean, just look at the free cash flow it cranks out. It's a cash printing machine. And that efficiency metric, turning 74 cents of every dollar of income into actual cash you can spend, that is incredible. This is HPQ's superpower. Now, to really understand HPQ's superpower, you need to know this one key term, a cannibal stock. It sounds kind of intense, right? But all it really means is a company that, well, eats its own stock. It uses its cash to buy its own shares right off the market, which makes the ones that are left more scarce and, hopefully, more valuable for the remaining shareholders. And this is exactly what HPQ does with all that cash. If you're wondering why anyone would invest in this slow-growth company, this chart is your answer. Since 2020, they have literally erased a third of their own stock from existence. Think about that. If you owned a piece of the company back then, your slice of the pie just got a whole lot bigger today, all without the company having to sell a single extra printer. It's a very powerful way to create value for shareholders.
So, if HPQ is basically handing its cash back to investors, what's HPE doing with its money?
Well, pretty much the exact opposite. It's taking its cash and plowing it right back into the business, especially into research and development. We're talking more than double what HPQ spends as a percentage of its revenue. It's a huge bet on the future, a sacrifice of today's cash for tomorrow's growth, especially in AI.
But here's the catch. That big bet on the future, it isn't free. To fund all that growth, HPE is taking on a good bit of debt. You can see it climbing here. They're basically borrowing to build for tomorrow. HPQ, on the other hand, is playing it much safer, keeping its finances pretty conservative. So you have a classic choice here. Higher risk for potentially higher reward, or lower risk for slower, steadier return.
All right, let's talk about the topic that's on everyone's mind, AI. It's the buzzword changing everything. And yep, both of these companies have an AI story to tell. But, you probably guessed it, they are coming at the AI revolution from completely different angles. So it all comes down to two very different bets. HPQ is betting on you and me. Their big idea is the AI PC. They think we're all going to rush out and upgrade our laptops to get new models with special AI chips inside. HPE, on the other hand, is betting on the big corporations. They're building the giant engine rooms, the AI factories, all the servers and networking gear that companies need to power their massive AI models in the cloud. So it's a bet on the device in your hand versus the bet on the massive data center you never even see.
Okay, let's do a quick recap. We've got the cash cow versus the growth engine. We've got shareholder returns versus heavy investment in the future. Now, for the moment of truth, what does the market think all this is worth? What's the price tag on these two different stories?
Now this slide to me is one of the most fascinating. We're looking at the price-to-earnings ratio, which is kind of like the market's hype meter for a stock. And just look at HPQ. It's squarely in the bargain bin. A PE ratio around 7 means the market is basically saying, yeah, we're not expecting much from you. It's priced for pure pessimism. HPE has a higher price tag, which reflects Wall Street's optimism about its growth. So with HPQ, you're buying today's reality. With HPE, you're paying up for tomorrow's dream.
All right, we have laid out all the evidence. We've looked at the numbers, the strategies, the risks. Now it is decision time. Let's bring it all home and figure out where you fit into this whole picture.
Let's do a final rapid-fire head-to-head comparison. Who's growing revenue faster? That's a check for HPE. Who has better profit margins? Another check for HPE. But what about a safe, reliable dividend backed by tons of cash? That's a huge check for HPQ. Who has the better AI story? Well, the market seems to favor HPE's big data center play. And finally, valuation risk. Which one is cheaper? I mean, way cheaper. No contest. With its low PE, that's a big check for HPQ.
So ultimately, this whole thing boils down to one simple question. What kind of investor are you? Are you profile A, the dividend and value investor? You want that consistent cash flow, you love the share buybacks, and you want to buy in at a low price. If that's you, you're betting on the stable cash cow, and HPQ is your stock. But maybe you're profile B, the growth and tech investor. You want a piece of the AI boom, you're excited about cloud growth, and you're willing to take on a bit more risk for that higher growth potential. Well, in that case, HPE is the one calling your name.
And that's really the bottom line. One iconic brand has split into two very different paths for investors. So the final question is for you. Are you betting on the cash cow, or are you betting on the growth engine?
And of course, just a quick reminder, this is all for educational purposes. It is definitely not financial advice. Please make sure you do your own homework before making any decisions. But hey, if you found this breakdown helpful, I'd really appreciate it if you subscribe so you don't miss the next deep dive. Thanks so much for watching.